Okay, so well, first of all, I would like to thank the Book Tissue Publishing Group for organizing these seminars, and in particular to Vahid. And it is for me a great pleasure to be part of this series, and I am really grateful to you for allowing me to present my results here. Okay, so I will tell you about financial risks. But well, I work in a mathematics department, as you can see here. So actually, my background is mathematical physics. Also, I have been working in financial risks for several years now. But my approach will be probabilistic, okay, and based on first passage times. This all will become clearer as we proceed with the presentation. But first of all, let me mention what is financial risk. Okay, so the intuitive idea is simple. For instance, here in Spain, we have some experts that say that the public pension scheme is under risk here in our country, not in the short term, but in the midterm, it is at risk. And they try to encourage people to do investments, for instance, in the stock market. Okay, but still, this is not really widespread in our society because of one reason: people is afraid of losing their money. Okay, and this is the financial risk. So, if you want a more formal definition, financial risk refers to the possibility of losses resulting from, well, many different causes. Depending on the cause, you can have a classification of risk. So the following is one such classification. The categories are not disjoint, and also the classification is not exhaustive. Okay, but I think it is rather illustrative. For instance, market risk, that is due to losses in changes in well, asset prices, interest rates, and so on. Okay, so this is a very classical risk. For instance, if you use internet frequently, you will find all these advertisements of people trying to sell you trading courses, and basically they say that you have to buy a stock when it is cheap and sell it when it is expensive, which is very easy to say, but not so easy to do. Okay, and this is these fluctuations in the prices are due to the volatility, and this is basically what market risk is. Also, credit risk when counterparties failing to meet obligations. Okay, for instance, you buy a house, you have a mortgage with the bank, and eventually you cannot pay it. Okay, so then this is the classical credit risk, and banks actually uh, study people just to minimize the risk of default. Liquidity risk, in this case, you have, say, enough collateral to pay your debt. But the problem is that your collateral is not liquid enough. Okay, so imagine you have several houses, and at some point you have to pay a debt. Okay, now you need to sell a house, but this might take a long time. Okay, unless but if you need the money urgently, then you can put a very cheap price to your house, and then you will assure that that you sell it in a short period, but with a big loss of money. Okay, so this is what liquidity risk is. And maybe some of you may remember that a couple of years ago or so there was a big problem with liquidity risk with some banks in the USA that create some financial earthquake. Okay, you may remember this appeared in the news worldwide. Operational risk. Okay, this is due to failures in system, processes, or governance. For instance, imagine you have some investment in crypto assets and some hackers attack the blockchain, and climate and environmental risk. And you have two types of risk in this case: transition and physical risks. Okay, physical risk refers, for instance, one example is, imagine you own vineyards, you produce grapes to make wine, and you experience very bad weather during 1 year, and this results in a poor production of grapes. So this is the physical risk. And transition risk, this is due to regulations. Okay, so in this case, you can imagine you own a car factory, you produce gasoline cars in the European Union, but at some point the European Union forbids these cars, and you basically are broke. Okay, so these are the two types of risks associated to climate. Before engaging into mathematical modeling, I think it is interesting to have a word of caution. Okay, so one of the greatest mathematical physicists of all times, Isaac Newton, he had real problems with finance. In the 18th century, there was a company, the South Sea Company, that obtained the monopoly of trade with South America. And well, this generated huge expectations on wealth being generated by this company, okay? Because people in England during that time heard about the amazing things that were in South America, that was considered a extremely rich country, at region, sorry, and extremely there was not. I mean, it was not a unified country, of course. It was considered an extremely rich region during that period in England. So this generated a expectation by investors in England who started putting their money in the company. And Newton himself started investing a little bit of money, and then the price of the company stocks grew, and Newton exited very happy because he earned some good money from this investment. But his friends stayed invested and became eventually rich. And still the value of the company was still growing. So Newton decided to re-enter with a lot of money, until at some point people realized that this expectation had no real basis. So basically, the bubble exploded, and the price of the company fell sharply, and finally Newton exited for a second time, but this time broke. Okay, and this is when he said, "I can calculate the movement of the stars, but I cannot calculate the madness of men." And indeed, he was able to to predict the position of celestial bodies, but let's say that the mathematics for the stock market is different. Okay, it doesn't rely so much on ODEs, but rather in probability theory. Still, it is good to keep in mind what happened to one of the best mathematical physicists of all times, to know that mathematical predictions should always, I mean, be put into some question, okay, when we address mainly real financial problems. Okay, so once this is said, let me introduce you one classical model of risk, the model introduced by Merton. He assumed that the value of a firm, Vt, follows a geometric Brownian motion. Okay, and default can only occur at some future time. Okay, we start at time t equals 0, At some future time, capital T, called the maturity, default can happen if the value of the company then is lower than the value of the debt faced by the company. Okay? Since the geometric Brownian motion follows a log normal distribution, computing this is just computing a normal probability. So it's very simple from the mathematical viewpoint. Some of you might think that this is maybe too simple, okay? But well, keep in mind that assuming that simplicity allows tractability, and in particular, you can build derivatives indexed to risk and prices derivatives and so on. Anyway, this is just to clarify the value of the simplicity here, but we are not going to enter into these topics, okay? But a different one. Another model for risk is the KMV model. Okay, I'm not going to enter into the details of this model. Just let me tell you that it's similar to Merton model, but instead of using a log normal distribution, this is a theoretical distribution. There is an empirical calibration of the distribution, so the distribution is constructed from data. It is quite interesting if you are at the university, at academia, that this model is owned by Moody's, the rating agency. Okay, this is at the university. It's not common to see these type of things, but in the real financial industry, it is. Okay, so some companies may have the intellectual property of a mathematical model. And finally, the model we are interested in, which is the Black-Cox model. Okay, this model introduces early default barrier. By this, we mean that default can happen at any time between now, which is t equals 0, okay, until the maturity t. And this default will happen whenever the value of the company follows below some function, okay, which we call the barrier function b of t. And this function models, it's a modulation of the depth of the company, okay? So the depth of the company at the final value, t equal capital T is d, and b of t is an exponentially increasing function, which final value is d. And this actually, I'm not going to enter into the details, but this is what happens. This is more accurate with respect to what happens in reality compared to Merton model, okay? So default can happen really at any time. Basically because companies are required to have some collateral for the credit. Mathematically, this means that the default is a first passage problem. Okay, this is a very well-known type of problems in probability theory. And you may wonder why the function is just an exponential, and the reason is that the continuous interest rate imposes this. Okay, so if you put some money into a bank account, and this is a riskless investment, there is no noise here, and according to the continuous interest, it grows exponentially. So what we only need to know is what is this safe interest rate R. Okay, and of course I am oversimplifying things. The financial reality is very complex, but to put things in a mathematical model, you need sharp, hard simplifications, right? So this interest rate is the one that is given by the central bank. Okay, so this picture shows the main building of the European Central Bank, which is this tower here. This is the River Main, and this is the city of Frankfurt in Germany, where the European Central Bank is. And central banks not only control the interest rates, but also they can inject money into the economy. And if they inject a lot of money in a short period of time, this creates inflation. Okay? And inflation can be modeled mathematically by this scale transformation. Okay? So we are scaling the value of the firm by this factor, which is time dependent. This means that the value of the company or any good is the same, okay? But as you are injecting a lot of money in the system, the price goes up. Okay? So the price you have the same value, things they have the same value, but you have much more money in the system. Okay, so this make prices increase. The situation actually it's not that different to what happens in cosmic inflation. Okay, in cosmic inflation, what you have is that the universe is expanding, and the energy of the universe is constant, stays the same. Okay? But as the universe is expanding, is growing, you have the same energy in a bigger and bigger universe. Okay, so somehow this is a parallelism to what happens in the case of the economic system. You have a system with goods, their value is constant, but you inject more and more money, so this has as a consequence that the prices increase. Okay, and actually this was part of our motivation to work into this problem because almost 10 years ago we did this paper studying diffusion processes in an expanding universe. For instance, you can use this to model cosmic rays, which sometimes experience diffusion, and this diffusion can be coupled to the inflation of the universe, and this generates effects on the diffusion process that cannot always be neglected. Okay, this is the aim of this paper published in 2016. And as I said, was one of the motivations to move to this case of the effect of monetary inflation into the economic system and affecting the value of a company or the price of a company. Okay, so before introducing the effect of inflation in the Black Box model, uh, let's take a look of how inflation looks like. Okay, so these are data from Argentina. Argentina is a problem that has been they are having a long-standing problem with inflation. So if you look here at pre-COVID times, you find oscillations, okay, in the rate of inflation. And then with the COVID crisis, these oscillations happened around a growing trend until a point where the increase is exponential. It reaches a peak and then it sharply decreases. Okay, so this is the effect of the policies by the new president of Argentina, Javier Milei. Overall, if you look at this picture, what you see is well, the presence of oscillations of increasing amplitudes. Well, as I said before, there are some models, some classical models of credit risk, like black box, that define default as a first passage of geometric Brownian motion through a barrier function. But in the real world, barriers are not simply growing monotonically. Okay, they are time varying because of many reasons. For instance, one of them is the presence of inflation, as I just showed you in Argentina, this uh, strongly oscillating inflation they had. Also, climate shocks, they have this structure. Okay, for instance, you can see this recent reference. The study precipitation. This means rain, basically rain in the Mediterranean basin. And what they found is that there is a huge spatiotemporal variability. This means in some corner of the Mediterranean coast, you find calm with light rain for some years and very strong and destructive rain for all years. And the situation, say the trend is more or less the same in a different corner of the Mediterranean coast, but the heavy rain is not necessarily correlated with the heavy rain in the other corner. Okay, so this is a huge spatiotemporal variability in the Mediterranean basin, as I said, and this creates oscillations in the case of heavy and destructive rain. Okay, rain can be very dangerous and harm people, but also, of course, it harms financial goods. It can destroy many investments. And basically, you have kind of the same structure of oscillations. Okay, in this case, in this case too. Okay, there are also other reasons, not only climate and inflation, but well, these are two clear examples. What happens if we introduce these oscillations? Okay, in this case, explicit results, so this means probability of default, mean time to default, they are out of reach. Okay. There is a lot of research in this topic, but basically explicit results are only accessible for barriers that are either exponential or constant, okay, or variants of those. Everything else, I think it's open. So this is what motivated us to do a qualitative three-level classification of financial risk. Okay, because we are based on the black box model, this classification will be built on first passage times. Okay, but now we want to focus on general barrier functions. Okay, so they can include any kind of oscillation. Let me now be more precise and start with the real math. So for our company, the value will be given by the solution of the Black-Scholes equation. Okay, it is well known that this equation has only one solution, so the solution is unique and it's global in time, and it's given by an explicit formula, which is the geometric Brownian motion. Okay, so we are coincide with the Black-Cox and Merton models in this model. And we will also consider default as a first passage event. So we will consider tau the first time that the value of the firm crosses the value of the debt. Okay, in this is the moment where default is triggered. With respect to the barrier, in this case, we will consider minimal assumptions. In particular, the barrier is continuous. That's it. That's it. We only assume the barrier to be continuous and deterministic. You don't need anything else really. Okay. The other assumption, we have other assumptions, but are not really fundamental. This assumption means that the barrier initially it's below the value of the firm initially. Okay. Otherwise, I mean, you have the default at time equals 0. So it's a case which is not interesting. And also we assume that the barrier is positive for all times. Again, you can assume that the barrier becomes negative at some points. Nothing essential changes in the proofs. But the way you write the proofs, the way you write the statements becomes more complicated. And this is something that is not it has no financial justification. Okay, so what the real financial assumption is to have it positive, and because mathematically it adds nothing essentially new, only more complication in writing down things. So we prefer to keep things simple and to assume positivity. But I emphasize that nothing mathematically changes really in essence if you want to have some more general barrier function. With respect to the classification, there are two key quantities we will consider. The heating probability, this is the probability that the default happens in finite time, okay? And we will only consider the cases when it is equal to 1 or fractional. It cannot be 0, okay? I will insist on that later on. And the mean heating time, whether it is positive, finite and positive, or infinite. It cannot be 0, okay? So these two dichotomies create actually a three-level classification. Okay, there are only three possible regimes. Okay? In principle, you have two dichotomies, so maybe tempted to think you have four possibilities, but this is not true. You only have three. Okay, this is easy to prove, and I leave this as an exercise for the audience. Also, this is the best you can have, because as I said, this cannot be 0, this cannot be 0, okay? So this is the best you can have unless you change the hypothesis, you introduce more quantities, or you introduce arbitrary thresholds, okay? If not, what the only classification, the only possible classification is this. So from a mathematical viewpoint, it is natural. Okay. Of course, this is a mathematical classification. You cannot apply it directly to a real financial system. It needs an adaptation. Still, you can learn lessons from it. Okay, that can be applied to finance. And this is what I'll show you at the end of the talk. Okay, so to be a little bit more explicit, these are these three risk zones. So the first one is the high risk, okay, the red flag zone. It is characterized by a mean heating time or mean default time, which is finite. Okay, so this happens that we have a well-defined time scale to default. There is a medium risk zone, the yellow flag zone, and in this case, the mean heating time is infinite, but the probability that default happens in finite time is 1. Okay, so in this case, default will happen with probability 1, but there is no well-defined time scale for the default to happen. And finally, the low risk or green flag zone is characterized by a probability that a positive probability of default never happening. Okay, so the probability that tau is equals infinity is positive. As I said, you cannot improve this. You cannot have this equal to 1. It's only either positive or 0. Okay, so more graphically, the higher risk, you have a well-defined time of the crossing of VT with the barrier. Medium risk, you have a trend towards default. This is default will happen with probability 1 at some time, but there is no well-defined time scale for default to happen. And finally, the low risk, you have a positive probability of not defaulting at any time. This is the general picture. Now let's move to the math, but before starting with the precise statements, let me mention the idea of the proofs. Basically, you can think of barriers of this form. You will have a exponential increase and exponential drift, okay, which is the average increase of the geometric Brownian motion. That's how you need to discount. And then you need some b tilde, which is this you can think of it as a perturbation of this average increase, okay? And basically, what you want to do is a logarithmic change of variables, okay? So of instead of comparing or computing the first passage of the geometric Brownian motion through a function, okay, after performing this change of variables, what we will compute is the first passage of a Brownian motion through a different function, okay, which is well defined, is b tilde, and can be obtained uniquely from the barrier b of t, which is the datum of the problem, okay. And we will focus on absolute values of b tilde growing sublinearly, because otherwise the problem essentially reduces to the one by Blackbox. Okay, so we are focusing on borderline regions. What I said in symbols. Okay, the default is the first time Vt crosses B of t. Okay, the first time the value of the firm gets to the value of the barrier. After performing the logarithmic change of variables, okay, we translate this problem on a first passage problem of Brownian motion through a different function, which can be obtained from the original datum b of t. Imagine for a second that your b of t increases monotonically. It's, for instance, an exponential, but we have inflation. Okay, we can introduce inflation using the scale transformation I showed you a few slides before. And in this case, the logarithmic transformation, the logarithmic change of variables, is this one here. Okay, so essentially, what inflation does is to modify the barrier and introduces an effective barrier. Okay, so even if the original b function grows monotonically, the oscillations will be introduced through the scale, through the monetary scale factor 8. Okay, completely equivalently, even if you have some b of t, which is a pure exponential, then your b tilde will be given by the logarithm of the monetary scale factor. Okay, so even in the classical Blackbox case, if you have inflation, you will have a b tilde, which is introduced in this manner. And one of the advantages of our three-level classification is that it is completely determined by the asymptotic behavior of b of t. You don't need fine properties of it, just its asymptotic behavior. Okay, so this is informally the idea of our development, but now we can move to the precise results. So first of all, this is our first theorem, so if you only remember one of our results, probably is the one to take home, because it's let's say the simplest. If one of these two conditions is fulfilled, then the default time is finite with probability 1. And what does this mean? So we have this ratio. In the numerator, we have the function b, and in the denominator, we have this function, which somehow discounts the exponential drift of geometric Brownian motion in both cases. And we have here a more complex expression, which is given by the iterated logarithm. Okay, so why these two terms here appear? Okay, now I will try to move to the. If you allow me 1 second, I will try to move to the whiteboard. Okay. So I can illustrate this with a picture. Okay, so okay, now you see the whiteboard. Now, this is, oh, sorry. Right. So this is one axis, the position axis, and this is the time axis. Okay. And now imagine that we have that. I don't know if okay, I don't have. I have colors here. Okay. So now I have a path of Brownian motion, like looks roughly like this. Okay. So sometimes people consider that a path of Brownian motion is contained in a parabola. Uh, Oops, let me see if I can paint it. Okay, a parabola goes more or less like this. Okay, and the reason is that the standard deviation Brownian motion grows like the square root of t. So this is why people simplify the mathematics, saying, okay, the paths of Brownian motion more or less spread in a parabola, okay? But this is not actually true. This is not a parabola, but is slightly wider than a parabola, and it's given by the law of iterative logarithm, okay, as I told you. And what the conditions that I showed you, we will be back to the slide in a second, mean are graphically, they mean the following. Okay, so we can choose a different color here. So imagine that our barrier starts here and oscillates. Okay. We have a limit of, we have a sequence of maxima of the barrier, okay, and a sequence of minima because the barrier is oscillating, okay. So the first condition means that the sequence of maxima asymptotically lie above the upper arm of this extended parabola, while the sequence of minima asymptotically lie above the lower arm of this extended parabola. So let's go back to the presentation. Okay, here we go. Here we are. As I said, the first condition, well, first of all, we use limit inferior and limit superior because uh, B oscillates, okay? So the limit is not well defined in general, but the limit inferior and the limit superior, they are always well defined, okay? In this case, this is the limit of the sequence of minima, and they should fall above, okay, look at the sign, they should fall above the lower arm of the extended parabola given by the law of iterative logarithm, okay. And in the case of the limit superior, this is the limit of the maxima, uh, it should fall above the upper arm of this extended parabola given by the law of the iterative logarithm, okay? You only need one of these. With one is enough, and then you have that the probability of default is finite, almost shallow. Be part of the theorem. Now, with respect to the mean default time or mean hitting time. In this case, we have something similar, okay, but we no longer have the law of the iterative logarithm because in this case we are computing the first moment. So in this case we have the pure parabola. We don't need to correct it with the iterative logarithm, okay. This result is limited, okay. I will improve it in a few slides, but this result is limited since we are comparing the full B, okay, b of t for all times is compared to this critical form of the barrier. If the full function b lies above this critical barrier, then the mean heating time is finite. However, if it falls below, again, for all times, this critical shape, then the mean finite time is, the mean heating time is infinite. Okay. But as I said, this can be refined, and this is what I'm going to do next. So let me remind you, this is our basic model, okay? The Black-Scholes SDE, we have a continuous barrier, and in this case, okay, as I said before, the probability of default is positive, okay? You cannot have a zero probability of default. So you only can have this probability of default equal to 1 or 0. Sorry, equal to 1 or fractional, not 0, okay? Moreover, the default time, this random variable, is positive almost surely, and its mean is also positive. So this means that the only classification that we can compute is either the probability is less than 1 or the probability of the heating probability is equal to 1, okay? And again, for the mean default time, exactly the same. It is always positive, so it can be only positive or infinite. You cannot have anything else, okay? This, as I said before, is a natural classification from the probabilistic viewpoint, and is the only classification that allows you to just focus on the asymptotic behavior of b of t. Okay? If you introduce, say, some arbitrary thresholds like 1/2, then there is a dependence that goes beyond the asymptotic behavior, and therefore a difficulty to have full proofs, to have theorems. But in this case, you can. But assuming this, okay, as I said before, the best you can have is the three-level classification. If you want something else, you need to change the hypothesis. You need either you change the hypothesis, or you introduce more quantities, or you introduce some arbitrary thresholds, but at the price of complicating the classification a lot, because the asymptotic behavior is not enough in that case. Okay, these two theorems, as I said, refine the first theorem, the first classification. The first one tells you when this probability of default in finite time is less than 1, okay? Because in the first theorem only characterizes the complementary case. But now we have that if the limit of the maxima of B lies or asymptotically lies above the lies below the lower arm of the extended parabola given by the law of the iterative logarithm, then you have a probability of survival forever. This is a probability that default, a positive probability that default will never happen. Okay. And the second result here, the second refinement looks very similar to one of the conditions of the first theorem. Okay, you probably remember this. The limit of the minima of B should lie above the lower arm of the extended parabola. Okay, but you can think, okay, this is exactly the same as in the first theorem. Okay, this is the first theorem. This is the first condition. Is this condition? Not exactly. Now is before we had this strict inequality, and now we have that the inequality is no longer strict. Okay, but the result holds. You might think this is okay, this is a tiny refinement. Okay, this is just a little bit better. In one hand, this is true, but on the other hand, let me say that the proof is completely different. Okay, in the other proof, you only need the Kinchin law of the iterative logarithm, which is the classical law of the iterative logarithm for Brownian motion. In this case, you need a refinement of this classical result that was proven by Erdos, well, decades after the first law was introduced. And not only at the technical side we can mention a difference, but imagine for a second that B of t is the path of a Brownian motion. Okay. In this moment, you can say, okay, but you said that B of t was a deterministic function. Right, this is true, but actually you don't need this. It is enough that B of t and V t are independent. Okay, and the proofs everything works. If they are not independent, then you cannot use this theory. But if they are both stochastic processes and B of t is independent of Vt, there is no problem. Okay, so B of t could be a Brownian motion which is independent of the Brownian motion that generates the value of the theorem. In this case, there is a very well-known result that is two Brownian motions with different amplitudes, possibly starting at different points, cross infinite time with probability 1. Okay, this is a classical result of probability theory. And basically, the problem in this case, well, you need this, sorry, not B is not a Brownian motion, but it's a geometric Brownian motion with the same exponential drift as Vt. Okay, but then the stochastic part is an independent Brownian motion. Okay, so the problem actually reduces in this case to the crossing time of two independent Brownian motions, which, as I said before, it is a classical result that they cross infinite time almost surely. Okay, this result is not recorded by is not covered by our first theorem. Okay, it's not a case that is decidable according to the first theorem. But in this case, yes, we can classify this classical result with its probability 1. Okay, so this is why having the borderline case included is important. There is yet a third reason, and but I'm going to that reason in one slide more. Before getting into that, let me mention that this classification of barriers is not exhaustive. Okay. So some barriers cannot be classified according to our theorems. In particular, those barriers that fulfill these three conditions simultaneously. Okay, and you can check that this is not ND set. There are many barriers that fulfill this. Intuitively, we are requiring for the barriers for the limit of the maxima of the barriers to be above the lower arm of the extended parabola. The limit of the minima should be below the lower band of the extended parabola, and the limit of the maxima should fall below the upper band of the upper arm of the parabola. Okay? In this case, we don't know if the hitting probability is fractional or 1. But imagine we don't have oscillations. Okay, by absence of oscillations, I mean that asymptotically they are not important. Precisely means that this limit superior and this limit inferior are equal. So in other words, the limit is well defined. Okay. If the limit is well defined, so asymptotically oscillations are not really important, then the classification becomes exhaustive. And we have and we can know if this inequality is fulfilled, then we have a fractional hitting probability, or if else this inequality is fulfilled and we have the hitting probability becomes 1. This is exhaustive because we can include the equal sign in the second relation, okay? And this is due to the last theorem I showed you. It looks like a tiny refinement, but this apparently tiny refinement is the one that allows you to have an exhaustive classification in the case of absence of oscillations. And let me tell you that, well, this now it becomes clear that in the case of the classical black box model with the monotonically exponential increase of the barrier, you cannot see this phenomenon of non-exhaustive classification and the presence of undecidable barriers. In the sense, you cannot say anything about these barriers. Okay, this is a phenomenon that is due completely to the presence of oscillations. Now, what happens with the first hitting times? Okay, again, we consider this critical shape for the barrier, and we can extend our result now to the asymptotic form. Okay, as before, we don't have limits in general because of the oscillations. We have limit inferior, but in this case we compare again with because we are going to moments. We compare to the classical parabola. Okay, to just the square root, which is the consequence of the form of the standard deviation for of the Brownian motion. In this case, if the barrier falls above the critical barrier asymptotically, well, not the barrier itself, but the sequence of its minima, then we have that the mean hitting time is finite. But if the sequence of maxima follows below the critical shape, then the mean hitting time is infinite. Again, the classification is not exhaustive. You can have undecidable barriers if these two inequalities are fulfilled at the same time. Again, this is not an empty set. This happens when the sequence of minima of the barrier follow below the critical shape, and simultaneously the limit of the maxima of the barrier fall above the critical shape. Interestingly, even in this case, even if the limit exists in this case, okay, of course, if you have an stick inequality here, the barrier is classified, but in the critical case, when the limit is equal to 1, we don't have a classification. We don't know what happens unless you can really order the barrier function with respect to the critical shape. Okay. In this case, if you cannot do this, this means that in this case you have oscillations that are vanishing. Okay? That you have oscillations for all times, which are asymptotically vanishing, but still they prevent you to classify this type of barriers directly. So there is a lot of uncertainty in this problem. Let me illustrate these general statements with some examples. We start with this barrier. There is an exponential drift, and there is some b tilde, okay, some perturbation for the, say, the exponential barrier that falls under the critical shape for very short times, but in the long time it goes above, well, both critical shapes, the one given by the law of the iterative logarithm and the classical parabola, but very slowly, okay, because we have just a logarithm here. Still, our results show that the mean first passage time is finite, and we can, using the same techniques used to build the proofs, we can prove an upper bound, which is relatively simple for this first passage. Still, we don't have an explicit solution in this case. Our second example shows again the same exponential drift plus b tilde, and in this case we just assume b tilde is convex and still increasing. And in such a case, we can prove that the mean heating time is finite and it is upper bounded by this constant. Complementarily, in our third example, we have the same form for the barrier, but in this case, we will assume that b tilde is strictly increasing concave and such that well continues at origin and such that it goes to infinity when t goes to infinity. Okay, in this case, we don't know if it is finite or not, but at least we have a lower bound, okay, in this case. Now, imagine that we have a barrier that fulfills all the properties in examples 2 and 3. Okay, so in particular, it is concave and convex at the same time. So this means that the barrier is linear, and well, because of the other conditions, particularly that b tilde is strictly increasing, we have a straight line with a positive slope. Okay, and in both cases, we had well, in these cases, we had a lower and upper bound, but which was exactly the same bound. So this means that in this case, we have an explicit result. This explicit result is not new. It can be derived using other techniques because basically this is a consequence of the theory of first passage times of Brownian motion through linearly moving barriers, which is classical. But we have obtained the classical result using different techniques. One more example. Now we have, well, the exponential drift as always, and now b tilde is really oscillating. Okay, so we have sinusoidal oscillations which increase linearly in time. So this is a case that cannot be approached with say, the classical theory. Still, you can bound it with the classical theory. In particular, you have this string of bounds for b tilde is obvious. We are bounding this oscillating function by two lines which are tangent to it. And we can use the classical results of the probability of the finiteness of the first passage time of Brownian motions through linearly moving barriers, because we have two linearly moving barriers bounding our b tilde. Okay, and if we apply directly this theory, we have these bounds for the heating probability, but actually the result can be improved with our first theorem, because there is a direct consequence of our first theorem that is, I mean, you can check this, it is really an immediate consequence. You can check that the heating probability is actually 1 in this case. And a final example. We have, as always, the exponential drift and now oscillations, but these oscillations go in the negative direction, okay? So heating is more complicated in this case. Still, you can do the same trick as before. So this is bounding b tilde by two tangent lines, okay? This is, well, you should understand tangency in an extended notion, because I mean the peaks of this function are not differentiable, but I mean it's quite kind of intuitive that you have these bounds for this function, okay? And again, you can use the theory of first passage times for Brownian motion through linear barriers, and you get for the heating probability exactly the same bounds as before, okay? But in this case, you cannot improve this result, but because this is one of the undecidable barriers of our classification. So in this case, the classical theory really gives you some more knowledge. Still, you can use the same techniques we use in our proofs to prove that in this case, the probability is equal to 1. Okay, it's not that It's not that straightforward to prove this because it's not a direct consequence of our results, but still you can do it. You need to substitute the kitchen law of the iterative logarithm, but by another law of the iterative logarithm, which is the Wigner law of the iterative logarithm. Okay, but using this you can prove it. The result is in our paper. And in summary, okay, this is how our classification can be implemented. So in particular, we have six quantities. Okay, so the first two refer to the behavior, the asymptotic behavior of the maxima of the sequence of maxima and minima of b of t, and how they compare with this extended parabola, which is given by the law of the iterative logarithm. Okay, because we are comparing with both lower and upper arms of this extended parabola, then we have four quantities, and we have two quantities more in which the comparison of the asymptotic behavior of the maxima of the minima and maxima of b of t is carried out with respect to the behavior of this of the usual parabola that is given by the standard deviation of Brownian motion. Well, not really satisfactorily, but it is what it is. There is no total order in between these six quantities. Okay, the as we say here, the order relation between these six quantities is only partial. Still, we have these partial orders that simplify a bit the classification. And the classification is, as I told you, in three levels. So high risk level, the red flag zone, is characterized by this inequality. Okay. If we have this inequality for some epsilon greater than zero, then automatically the mean heating time is finite, implies that the heating probability is 1 and the risk is high. The yellow flag zone is characterized by these two inequalities that should be fulfilled simultaneously. And then we have that tau is finite almost surely, but its mean is infinite. And finally, the green flag zone is characterized by this inequality. In this case, we have that the survival probability, this is the probability of no default, is positive, but of course implies that mean default time is infinite. But as I already said, the classification is not exhaustive. It's quite extensive anyway, but not exhaustive. For instance, if these three inequalities are fulfilled simultaneously, we don't know whether the hitting probability is fractional or 1, or the survival probability is positive or 0. Okay, this is completely equivalent. Moreover, we can distinguish between a twilight zone for which we know that the mean heating time is infinite, but we don't know anything about the almost sure finiteness of tau. And there is a dark zone in which we know nothing about any of them. We don't know about the almost sure finiteness of tau, and we don't know about the finiteness of the mean heating time. This twilight zone contains the cases characterized by these inequalities, and the dark zone includes the cases uh, characterized by these inequalities, except when we have a variable which coincides with the critical one, which turns out to be an explicit example. And you can easily check, okay, I will not do it. This is another exercise for the audience. It is easy to check that I mean, the fulfillment of this inequality simultaneously does not lead to the empty set. Okay, so there are many variables that fulfill them. And finally, there is another twilight zone, which is characterized by a heating probability equal to 1, but we don't know anything about the finiteness of the mean heating time. Okay, and in this case, this happens with these two inequalities are fulfilled simultaneously. And also, another exercise for the audience, this is to check that no other twilight zones are possible. So, some conclusions of our theoretical work, our mathematical work. First of all, we were inspired to build a discrete qualitative classification of risks in another classification, which is the one or are those made by the credit rating agencies like Standard and Poor's, Moody's, and Fitch. Okay, they also do a qualitative classification of risk in which is discrete, but far more complex than ours. And it's a classification which is quite famous based on AAA, triple B, and many other groups. Our three-level classification, okay, is well founded mathematically, and we have full proofs to classify the barriers in it. But of course, and well, the good thing is that it admits any continuous barrier. Okay, so it's very general. But if you want to apply this to the real world, you need to adapt the results. Okay, so it cannot be immediately applied. It generalizes the classical black Cox model by introducing an arbitrary time evolution of the barrier, and this way it includes some effects like inflation, like extreme weather events, and others. However, and this is interesting, despite the mathematical idealization, the classification of risk is not exhaustive. Okay, and this might be a call of attention to potential attempts of classify risk in changing environments, for instance, due to inflation or extreme weather. Okay, so in some real cases, we might not be able to classify risk. I mean, we just might simply don't know. So let me for a second go back to Newton. In this case, I'm showing you a painting by William Blake, the English artist, which depicted Newton trying to describe the universe in geometric terms, but failing to do so. Okay, because the universe is too complex to reduce it in this way. Okay, and William Blake, who was really not very much happy with science, actually it turns out that he disliked very much optics, for instance, said that art is the tree of life while science is the tree of death. Of course, as scientists, we must reject this claim, right? But still, we can see that even in a relatively simple idealized mathematical problem, we cannot classify risk completely, okay, only partially. So imagine what could happen in a real problem. So the universe is really complex, okay, and we should be also, I mean, we should be aware of this, okay, when we do these models and not do too strong claims, okay, like this claim by William Blake, which is definitely too strong. Okay, we it's not a good idea to go to the other extreme and say that science is everything and we can solve everything with mathematical models. Okay, the truth is somewhere in between of these two extremes. Let me mention some possible applications. Okay, our mathematical framework assumes tacitly that the maturity is infinite. Okay, so this it's better. Anyway, it needs adaptations for the real world, but it is better adapted for sovereign debt. Okay, because in this case the debt is continuously refinanced, and the assumption of infinite maturity is not that bad. For other scenarios, you need further adaptation. Okay, for instance, credit risk. Usually, in this case, the credit risk for companies. In this case, you usually need to include a finite maturity. In the case of green finance, well, we think that our results are particularly interesting in this case, but you will need also some adaptation. And additionally, in the case of testing and subtech, so this is the regulator of risk by the regulation of risk made by public regulators. They can also try to implement our results because they are very much focused on borderline cases, which are the cases that are not seen by the black box model. Okay, still some cases are not decidable, but at least our classification is much more extensive than the classical classification in the black box model that does not see all these B tilde growing sublinearly. And with respect to future work, we are now interested in doing a quantitative classification of risk, okay, not only qualitative but quantitative, going beyond the results I just introduced you to. And in this case, we will need some numerical implementation using different techniques, but I mean we will have some, say, partially theoretical, partially numerical results, but it's not possible to have. I mean, we will go way beyond pure numerical results, but it's not possible to have something which is completely theoretical, okay, as in the case I just introduced you. If you are interested in the topic, I can recommend you some references. For instance, the first one is a book in which you can read more about risk modeling. Our results in this talk are all present in this paper which is submitted to the archive. It appeared in July this year, and it's submitted to publication in a journal. If you want to know more about the mathematical methods of financial markets, you can, for instance, read this book, which is a very nice reference. Also, I want to make a little tribute to Kinchin, who introduced his law of iterative logarithm. You can see more than a century ago, and we are still using it today. So I think this deserves a tribute. Many of the properties of Brownian motion we have employed can be found, for instance, in this book. There are other monographies about Brownian motion. This is a pedagogical book, and where you can learn a lot of the properties of Brownian motion. And finally, we are working on, as I said before, we are working on a quantitative classification of financial risks, but well, we still need couple of months to have this second paper ready. I would like to thank both the government of Spain and the European Union for funding our research through these three projects. Also, I would like to thank the taxpayers of Spain and the European Union because ultimately they are who really finance these programs and these funders. And that's it. Thank you very much for your attention.